So, if you look back at July 3rd, 2026, the most famous, never sell Bitcoin zealot on earth quietly built a back door to basically liquidate their stash.
Yeah, which was massive.
Right. And then just a few weeks later, the United States and Japan had to stage this massive coordinated currency intervention just to stop a global financial bleed.
This is Echoes of Insight from Ecoscopia. A man who cannot read his own body is a man being managed. A man who cannot read market cycles is a man being moved by forces he will never see coming. A man who has never voluntarily walked into discomfort is a man whose courage is theoretical. These three failures are not separate. They are the same failure. The failure to become your own infrastructure. Blood, coin, forge. This is the correction. Every dive takes a subject you've only met in fragments and holds it under light until the structure shows. Today, what people are calling an AI bubble and a crypto winter, and whether they are two stories or one.
This massive coordinated currency intervention just to stop a global financial bleed. And if you just glance at standard financial news, those look like two completely separate stories, right? Like, one is this quirky crypto capitulation thing, and the other is just, dense macroeconomic policy.
Right. They seem totally unrelated.
Exactly. But today, we are going to prove to you why they aren't separate headlines at all. You're actually watching the exact same story unfold in real time.
Yeah, it's a massive structural shift. When we look across today's stack of sources, and it's heavy today, we're pulling from Apostle Fund's macro reports, Bitwise's on-chain data, this really fascinating MIT economics paper.
Spot Gamma too, right?
Yes. Spot Gamma's volatility analysis and the sovereign method framework, they all converge on this one incredibly consequential premise. We are witnessing a single, massive reallocation of the world's risk capital.
And that's really the mission for this deep dive. We're bypassing the usual, market chatter to trace the actual plumbing of global liquidity here.
Exactly.
Because right now we have this unbelievable AI sitting right next to a truly painful crypto drawdown, and it's all backed by a sovereign debt crisis. To understand how they connect, we have to look at the mechanics.
We do.
So let's just start with the hard evidence. Walk us through those two events from the summer of 2026.
Okay, let's look at event A, July 3, 2026. The software company Strategy, trading under the ticker MSTR, they practically made holding Bitcoin forever their entire corporate identity.
It was their whole brand.
Right. But on that day, they quietly adopted what they called a $1.25 billion digital credit capital framework.
Which sounds very fancy.
It does, but stripped of the corporate jargon. The most ideologically committed holder of digital scarcity on the planet built a mechanism that allowed them to sell.
Which is just mind-blowing if you follow the space at all. It's like watching a devout religious leader quietly auction off the pews in their sanctuary.
Yeah, that's a good way to put it.
The market just didn't quite know how to price that ideological pivot, but then Event B hits.
And Event B pulls us completely out of the corporate world and right into the jurisdiction layer.
Right.
So spanning July 31 to August 1st, 2026, the U.S. and Tokyo engaged in the first coordinated dollar-yen intervention in over a decade. And the timing, honestly, is what makes this a smoking gun.
Because of the debt number.
Exactly. This intervention happens mere days after the U.S. national debt crosses a staggering $39.84 trillion.
Let's just put a pin in that number for a second, because $39.84 trillion is so large, the human brain actually struggles to process it. Like, to give you some scale, that means the U.S. debt was growing at roughly $12.6 billion every single day.
Every day. And that daily growth is the engine driving this entire phenomenon, which, forces us to confront the core fracture in how the market understands this period.
Right, the big debate.
Exactly.
Right.
We have a corporate Bitcoin capitulation on one side and a sovereign currency intervention on the other. So the central debate is this. Are we looking at a singular, massive reallocation of risk capital cascading across three distinct pillars? Crypto, AI, and sovereign debt? Or are these just isolated markets doing their own thing?
And I want to explicitly ground this debate in a framework from one of our sources, Ecoscopia and their sovereign method.
Right, the coin pillar.
Yes,
Yeah.
specifically their Koyan pillar.
Yeah.
Because in this framework, Koyan is all about markets, cycles, and timing, right? It separates the cold analytical operators who understand how capital actually rotates from the people who get trapped fighting a moral crusade for their favorite asset.
The coin pillar is crucial here because it strips away the emotion. Like a moral narrative says, my asset is technologically superior, therefore it must go up.
Right, the inevitable victory.
Yeah, but the coin reality says capital doesn't care about your morals. It cares about risk-adjusted returns.
Okay, I agree with the theory there, but I have to push back on the mechanics a bit.
Go for it.
If I am looking at this strictly through the coin pillar, it's very easy to just wave my hands and say, oh, it's all one big pool of liquidity, everything is connected.
Yep.
But mechanically, how does a tech behemoth in Silicon Valley buying $1 billion worth of AI chips directly drain liquidity from a decentralized digital currency? Like, what is the actual physical bridge between those two actions?
That is the exact right question to ask, because capital doesn't just teleport.
Right.
The connective tissue here is the marginal buyer, and the bridge is the exchange-traded fund, the ETF.
Ah, okay.
We saw this mechanism work in reverse perfectly when BlackRock's Bitcoin ETF posted a record $527.8 million single-day outflow.
Literally $500 million draining out of a single pipe in one afternoon.
Exactly. And that capital didn't evaporate. Institutional capital blindly chases the highest risk-adjusted returns, which analysts measure using Sharpe pay ratios.
Yeah.
But even more importantly than the return itself, there is a massive duration mismatch driving this rotation.
Okay, let's translate that for a second. When you say duration mismatch, you're talking about the timeline for when an investment needs to pay off, right?
Yes, exactly. Think about AI capital expenditure. Tech companies are buying silicon chips and building these massive server farms today.
Right.
That infrastructure requires a 12 to 18-month return horizon. They need to show revenue fast to justify the massive spend to their shareholders.
Okay, and crypto.
Bitcoin, on the other hand, is priced on a 10-year store of value horizon. It's a long-term hedge.
Right, so think of the ETFs like communicating vessels in physics. Once you connected Bitcoin to traditional finance through those ETF pipes, capital basically became a liquid that instantly flows to whichever side has the steeper slope of returns.
That's a great analogy, yeah.
So when AI started offering this immediate, verifiable, high beta momentum, meaning it was just moving faster and harder than anything else in the market, the institutional pipes just ran in reverse. They drained the 10-year hedge to fund the 12-month momentum.
And the institutional investors had a very solid theoretical justification for doing so. Which brings us to the Steelman case.
The bull case for AI.
Right. The absolute strongest argument for why this massive capital rotation into AI is completely rational. The MIT economics paper on speculative growth, it argues that unlike the dot-com bubble of 1999, the current AI boom is backed by real, tangible metrics.
It's not just eyeballs and clicks this time. I mean, it's actual hardware sales, massive software subscriptions, real, verifiable cash flows.
Yes, and the MIT paper details this fascinating macroeconomic mechanism they call the wealth-saving channel.
Okay, how does that work?
Well, when a transformative technology like AI is deployed, it creates massive efficiencies. And those profits shift heavily toward the capital owners, the companies, and investors building it.
Makes sense.
As those owners accumulate massive wealth, they look for places to park it safely. Because there is just so much wealth looking for a safe harbor, they are willing to accept lower true returns.
So the sheer volume of wealth being generated actually ends up suppressing interest rates naturally.
Exactly.
Which, ironically, makes borrowing cheaper and fuels even more investment into the very thing generating the wealth in the first place. It just becomes a self-fulfilling loop.
Precisely the argument. So for a traditional fund manager, capital moving to the highest risk-adjusted return isn't a glitch in the system. It is capital doing exactly what it was designed to do.
Right, and psychologically, I mean, this is the perfect excuse for Wall Street. You don't have to wrap your head around a new, complicated digital financial system if you can just buy a semiconductor company that prints actual verifiable cash today.
Yeah, it's much easier to justify.
It's safe, it's defensible to your clients, and it fits neatly into traditional valuation models.
It does. Yeah. But here, as with all financial narratives that feel a little too perfect, we have to flip the coin and examine the counter evidence.
Yeah.
Because the sources point out a really glaring vulnerability.
You're talking about the 95% statistic.
Yes, I am. The MIT report highlights what they call the Gen AI divide.
Okay.
While the hardware builders are making billions, the companies actually buying the tech are really struggling to monetize it. An astonishing 95% of enterprise AI pilots failed to deliver any return on investment.
Wait, 95%?
95%. The capital expenditure going into AI is far, far outpacing actual end-user monetization.
Okay, hold on. If 95% of these enterprise AI projects are failing to show returns, we're essentially funding the biggest global infrastructure project in history based on software that, frankly, still occasionally hallucinates recipes for poison.
Yeah, pretty much.
I mean, that isn't a rational macro strategy. That is a panic disguised by hardware sales. What happens to the entire stock index when the handful of companies selling the picks and shovels essentially become the whole index?
That concentration risk is the Achilles heel of the current market. The transition to this high-capital AI state requires a massive belief-supported valuation just to fund the build-out.
Right.
And because that infrastructure requires so much immediate cash, the market had to liquidate other assets to feed the beast, which is exactly what broke the crypto markets.
And that trail of bodies brings us to the casualties of this rotation, because the collateral damage here is very real. Let's look at the Bitwise data from January 2026.
Right, so the toll this liquidity transfer took on crypto was historic. Bitcoin suffered its deepest correction of the cycle, dropping from its high of $126,000 down to a local low of around $80,500.
Wow.
That is roughly a 35% drawdown.
And a lot of analysts just assumed this was, the typical tourist wipeout, just retail investors getting spooked and selling.
But the on-chain data proves otherwise. Bitwise tracked the SOPR, or the spent output profit ratio.
Right, the capitulation tracker.
Yeah, to translate that for everyone, it's basically a metric that shows whether the coins moving on the network are being sold at a profit or a loss. And the SOPR turned persistently negative, meaning long-term investors were consistently locking in losses day after day.
People who had held for years were giving up.
Exactly. We hadn't seen realized losses from conviction holders at that scale since the FTX collapse in 2022.
Which brings us right back to our first major event, MSTR adopting that framework to sell. SpotGamma's volatility analysis breaks down exactly how and why that never sell doctrine was abandoned. And to understand this, I think we have to unpack a little bit of corporate finance mechanics.
Yeah, let's do that. Because MSTR wasn't just holding Bitcoin, they were heavily leveraged. They used variable rate STRC preferred shares to fund their acquisitions.
Right.
Simply put, they issued debt with a floating interest rate to buy their Bitcoin.
And as long as the market believed MSTR stock would just shoot to the moon, everything worked. Investors were totally willing to pay a massive premium, what options traders call call skew, just for the chance to catch that upside.
And that premium effectively subsidized MSTR's borrowing costs, allowing them to impersonate like a zero-interest money market fund. They maintained this zero peg.
But when the liquidity started draining out of crypto and into AI, that call skew died.
It just vanished.
Yeah, the market stopped paying a premium for MSTR's upside. Suddenly, those floating interest rates started biting hard. To fund a 12% dividend on those preferred shares, they basically had no choice. They sold 3,588 Bitcoin at a realized loss, with an average basis of $61,197.
So their brilliant funding machine just violently ran in reverse. I mean, they didn't sell because they stopped believing in the asset. They sold because the market stopped subsidizing their debt.
Precisely.
They literally had to pawn the family silver just to pay the mortgage on the vault. It just proves that even the strongest ideological diamond hands are eventually forced to bow to the cold math of credit.
It really does. And that local failure in corporate credit, it points to a much larger global issue. Like, why were borrowing costs so high in the first place? Why was liquidity draining so incredibly fast? Right, where's the pressure coming from?
If we widen the lens to the macroeconomic backdrop, we hit the jurisdiction layer. This is where the Apostle Funds report becomes absolutely critical.
So let's bring back that $39.84 trillion elephant we put a pin in earlier.
Yes. The U.S. sovereign debt trajectory is the black hole, pulling on everything we've discussed today. Starting 2026, over $36.5 trillion, crossing $39.84 trillion by mid-year, and currently projected to hit $55 trillion by 2034.
Unbelievable.
And the net interest payments alone exceed $1 trillion annually.
$1 trillion just to service the interest on old debt. I mean, that is 15 cents of every taxpayer dollar burning up in interest, completely surpassing the entire U.S. defense budget.
And to pay that interest, the U.S. Treasury has to issue more bonds at attractive yields, let's say 4 or 5%.
Right.
That acts as a giant global vacuum. If you are an international fund manager, why would you risk your capital in a volatile overseas market when the United States government is offering you a guaranteed risk-free yield?
You wouldn't. And that is the physical mechanism that explains Event B, the coordinated U.S. and Tokyo dollar-yen intervention. The U.S. Treasury's massive vacuum was sucking so much capital out of Japan that the yen was crashing. The currency markets were literally breaking under the pressure of funding the U.S. deficit.
Yes. By keeping yields high to fund its own debt, the U.S. is effectively exporting its deficit to nations that are heavily exposed to dollar-denominated debt.
Wow.
Japan couldn't handle the outflow anymore, which forced Tokyo and Washington to step in and artificially plug the hole.
And I want you, the listener, to deeply consider your geography in this equation, because the so-called safest asset in the world, the U.S. Treasury, is being aggressively issued by the most indebted government in human history to fund a massive structural deficit.
Exactly.
Your exposure to this risk completely changes depending on which passport you hold. I mean, if you are sitting in New York riding the AI wave, this just looks like a bull market. But if you are in an emerging market, or even Japan, watching your currency devalue as capital flees to the U.S., this is an existential crisis.
It is a profound structural imbalance. And I think this brings us back to processing this massive shift through the sovereign method framework. We already diagnosed the coin pillar, right?
Right, reading cycles versus narratives.
Exactly. The operators who saw the AI rotation coming adapted, while those fighting a moral crusade for crypto got crushed by the credit math.
But the sovereign method has two other pillars that are just as important here: blood and forge. Blood is about the physical nervous system impact of markets. I mean, a 35 to 50% drawdown across 9 months isn't just numbers on a screen. It is a physiological event.
It really is.
The people who panic sold at the absolute bottom weren't just out-analyzed by the quants, they were out-regulated by their own biological stress responses.
Which leads directly into forge. Forge is the concept of voluntary discomfort. It is the raw grit required to hold a position through a terrifying months-long capitulation. But equally, it represents the extreme humility required to exit a position that you publicly championed.
Look at MSTR. Just imagine the absolute humility it took for a company whose entire brand was "we will never sell" to quietly build a backdoor and sell at a loss just to survive a credit crunch.
A lot of humility.
Right. So if you are sitting there holding tech stocks or crypto right now, you really need to ask yourself which requires more will. Holding your ground through the fire of a massive drawdown, or publicly admitting your fundamental thesis was wrong and selling at a loss to protect your capital. Have you actually rehearsed either of those scenarios? Because as we've seen today, the market doesn't care about your ideology, it only cares about your execution.
And execution requires making decision based on probabilities.
Yeah.
Based on sources, we are basically looking at two distinct conditional scenarios for the future. And to be clear, we're outlining the conditional structures here. We're not making a prediction.
Exactly. We don't do financial advice on this show. You have to decide alone how to position your capital and your mindset.
So scenario A is the cyclical view. This is a classical post-halving crypto cycle that is just temporarily wearing a new AI-driven narrative.
Okay.
The on-chain data from Bitwise suggests that these bottoming formations take time, maybe another 2 to 4 months, as assets slowly transfer from weaker hands to high-conviction investors. If this is true, the decentralized narrative will recover, and it simply requires patience.
But scenario B is the structural view.
Correct. Scenario B is that we have witnessed a permanent structural liquidity transfer. In this world, decentralized experiments were liquidated specifically to build centralized AI infrastructure.
Right.
If this high-capital AI state sustains itself through real productivity gains, the wealth-saving channel permanently alters the interest rate environment. The old crypto cycle models might be broken for good. However,
95% failure rate.
Exactly. If that belief wedge fails, if those 95% of failing AI pilots cause valuation to crash before the infrastructure becomes self-sustaining, the entire transition collapses.
You really have to decide which side of the probability curve you are standing on, because the scale of what we've unpacked today is staggering.
It really is.
We started with the sheer irony of a never-sell corporate zealot being forced to dump their treasury. We tracked how institutional ETF pipes reversed flow, draining the 10-year store value to chase the 12-month AI momentum. We looked at the Gen AI divide, where 95% of enterprise pilots are failing to show a return. And we traced all of it back to a $39.84 trillion sovereign debt machine acting as a global vacuum, pulling capital away from overseas markets and forcing international currency interventions.
It is a single, interconnected ecosystem. The liquidity drains from the decentralized edges, flows through traditional finance pipes, chases the immediate momentum of AI, and is ultimately backstopped by a sovereign debt engine running incredibly hot.
So what does this all mean for you? I want to leave you with one final, lingering question to explore on your own as you look at your own portfolios and assumptions. If the current AI boom is ultimately acting as a massive centralized vacuum for global liquidity, what happens to the concept of decentralized sovereignty if the only entities that survive this transition are highly indebted governments printing money and tech monopolies hoarding all the hardware? If the zealot is forced to sell his sanctuary just to buy the mayor's duct tape, where do the rest of us actually build our future?
It's a heavy question.
It is. Thank you for joining us on this deep dive. Keep questioning the narrative, and we'll see you next time.
That's the dive. Sit with it before you act on it. Ecoscopia.net. Timing, cycles, and the work of staying sovereign. Subscribe and send the topic you want taken apart. Blood, coin, forge, echoes of insight.